conversation I want to have with all of you is really to pin down what are the elements that will drive innovation in financial services going forward, and the extent to which infrastructure, regulation, certainty helps the process, which is what people in the industry are familiar with today. If we just keep the conversation going, and if I were to ask David, what are some of the disruption technologies that are coming into place now that we need to be aware of, that both puts the regulator on notice, but at the same time creates opportunities?
So I'll answer your question about what is the cutting edge of innovation in financial services two ways. First, I'll talk about the technologies. Just a quick laundry list: AI, artificial intelligence, blockchain, advanced analytics. I mean, these are some examples of a confluence of forces that it's not one thing. It's not just blockchain or just AI or just analytics or just communication networks or just. They're all coming together at the same time that's driving this transformative change. And so there are a number of implications to that. But I set all that aside. I mean, again, I sit in a place where there's a new innovation coming up daily. At MIT, and so it becomes a little commoditized. What I've really decided is that there's something at a higher level that should drive what we're doing, and that will drive what we're doing going forward. And it's values-based. So on the entrepreneur side, I would call it inspired innovation or inspiring innovation, as opposed to just innovation. So on the investor side, I'd call it visionary investing. People have started to say that profit alone is not enough, that we have a view of the world being different and better, and we want that to be expressed through our activities and through our capital. And so from that perspective, I think that businesses that do well by doing good, that have both a market rate or better return and also some positive benefit to society, are the ones that are going to win long term, because we're seeing a shift in values. It's not just millennials, so they're certainly a major driver. A plurality, something like 42% of people in 22 countries that were surveyed by BBMG want to see both profit and purpose. And so when we think about what we do, when I think about what I do with my academic work at MIT, with my startup, Distilled Analytics, it's solving really big problems for the world that also address market discontinuities that can create tremendous profit.
The question is, how from this conversation do we sort of morph an idea of what we need to look for in innovation and how that's panning out? So, we have with Barney Frank, who has to sort of map out how the legislation that he's put in place is going to play out given all the changes that are taking place in finance today. So Barney, maybe you can start with a sense of how the Dodd-Frank Act will continue to be relevant.
Well, we tried very hard to avoid the mistakes of only solving the past problem and not going forward. Obviously, people say don't fight the last war, but the war was going on when we were doing this. We were in the midst of it. We tried very hard not simply to deal with things that had shown to be problems, but to give the regulators the power to get into new things that we couldn't think of. For example, we gave them the power to regulate activities, not institutions. So there are certain things, whoever does them will be covered by these rules. We also specifically set up, and I was pleased to hear David, whom I respect, say some nice things about his work, the Office of Financial Research, whose job it is to be open. They don't have any ongoing responsibilities. It's a federal agency charged with thinking about the future, and particularly about what might be problematic and how to deal with it.
Ron, what is your experience with regulation at the moment, and how much of it is Dodd-Frank and how much of it is regulation that needs to be made up as we go along?
So I think regulation is an important part of making sure everyone's doing the right thing and that everybody wins: the borrowers, the investors, the savers, the people paying, the people moving money. And so regulation is also part of innovation. And so there's innovation and regulation in old ways of doing business, and there's innovation of brand new things. Whereas Barney said this morning, the regulation, without too much time lapsing, will catch up with some of this new innovation.
But what is your conversation with regulators like? What are your conversations focusing on?
So for Prosper, we are very regulated. We're SEC registered, We file prospectuses every day.
Were you regulated from the word go, like from the beginning?
We
or-
were not. Our regulation with the SEC started in 2011. And then we're also registered with all the states where we have borrowers and investors. And then we also work with a bank to actually originate the loans. And so we work with their regulator. So FDIC, OCC, FTC, and others. So we're very much proactive. We want to make sure the regulators understand what we're doing and what we're not doing and the benefits that the borrowers and the investors are getting.
Barney, the key in the US seems to be which regulator has national charter and which regulator is domestic, which regulator has an overview of regardless of institution, and which regulator has kind of a purview over types of
Well,
institutions.
the complication in America, unlike I think any other country, there may be one or two, is that we have state chartered banks and federally chartered banks. What Ron just said, he had to deal with both. And right now, actually, the state chartered banks, the state regulators, protective of their jurisdiction, recently opposed the national regulator, the control of the currency, who is trying to encourage the new forms of lending. And of course, that's a problem in any area where the incumbents tend to be resistant. Although I have to say, it's kind of interesting for me because a lot of people in the banking industry who tend to be conservative politically have been preaching to other people in the economy that they should not fight obsolescence, that they should let technology go forward, that they shouldn't dig in their heels and say no. And then all of a sudden these entities come up that are doing that to them, like these two gentlemen. And all of a sudden this notion that you should just go with the flow and not try to preserve outdated forms, some of the bankers have decided they don't really believe in that.
Tang Ning, give us a sense of your journey in terms of how, as you were building marketplace lending in China and your interaction with regulators, was it all through the process or it started stepping up like more lately?
Yeah, several considerations. One is that regulation actually comes later. Yeah, innovation comes first. Yeah, Chinese regulators have done a good job in this financial innovation space, using marketplace lending as an example. When the industry was fast developing, the regulators made it very clear what the guiding principles would be in the upcoming regulation, well before the detailed implementation became in writing. Yeah, so I think market participants were quite aware of what they could do, what they were not allowed to do. And also, I think the relationship between the regulators and the innovators can be conducive. And also, the regulators can also learn from the market the best practice. For example, now one key regulatory requirement is that marketplace lenders have to work with bank institutions for funds custodian. And even before this regulation came out, companies like CreditEase had already been trying to work with banks on that front. So the innovators did it first without a regulatory requirement because we really wanted the industry to do well. So this is a very good example how industry best practices have later on become regulatory requirement.
David, what would you say to the idea that innovation in finance that we've seen so far have only ever taken place when the regulator was not watching?
Well, so we've spent some time on this question of does innovation only happen around the edges when the regulators aren't paying attention? And here's what we came up with. First of all, we talked to the regulators and heard their opinions on this. And in full disclosure, we authored a white paper on fintech and policy and regulation together with individuals associated with the OFR, although it is not an official OFR white paper, it's an MIT white paper. And so, one, I think when you look at successful regulation of technology innovation, the example we cite in the paper is the Clinton Magaziner e-commerce principles. So if you remember back in the late 90s, e-commerce was coming up and everyone was worried about, how's it going to disrupt existing retail and what were the implications and what should we do? And there's all these companies coming up and what are they doing? And the approach that was taken was a very light touch to regulation. And this ended up fostering an e-commerce industry that reduced costs to consumers, that improved access to goods, that generated greater efficiency. And so I would view a successful implementation of regulation and policy. In contrast, I look at New York State's effort at regulating Bitcoin with the BIT license, which had the effect of crushing innovation and crushing new ideas and new companies. And so our view is the regulators, when I've spoken to them, the most enlightened ones or the most honest ones say to me, look, we like to allow things to happen around the edges when they're small, and when they get big enough to really have significant impact, then we step in to regulate. And they say policy will always lag innovation. It has to, because you have to see a lot of different things tried out before you figure out what's really gaining traction.
But the interesting thing about the regulation that you're talking about is that there's regulation to protect what is being created, and there's regulation that stands in the way, right? So in the case of the
I don't think it's a bipolar. I think there's regulation to protect what's being created, to protect free enterprise. There's regulation to protect the individual consumer, so that you don't end up with creating disenfranchisement and digital exclusion. And so these aren't necessarily in opposition, but sometimes they are. And navigating that is non-trivial. Frankly, before I started talking to regulators and getting more informed about it, and I don't pretend to be an expert, I was more skeptical about regulation. I was much more of a, let 1,000 flowers bloom. And the more that I've talked to folks who are in the position of dealing with these issues, the more complicated I realize it is. That regulation, when properly implemented, can be a sword and shield to protect the poor and the illiterate.
You're going to say?
Yeah, so when we first got started, when we invented the marketplace lending model 11 years ago, we didn't seek any counseling guidance from any regulator, not because we didn't want to, just because we had nowhere to go, right? There wasn't any such a regulatory component in the framework to give us any okay or otherwise. Yeah. So but after the model grew to a certain stage, like different regulators, started to make comment on it. Although at that time there wasn't clear who would be the ultimate regulatory body. Until like last year, it was like decided that the Central Banking Regulatory Commission, as well as local finance offices and bureaus, would be responsible for this model supervision. So, but I guess it's a healthy process along the way.
One other purpose of regulation, and that's to protect competitors from each other. It is to protect people from unhealthy competitive pressures. One example I would give for that was a major piece that came out of the banking committees of the Congress before I get deeply involved, and that's what's called the Sarbanes-Oxley accounting bill. What that does is it protects you against your competitors playing games with the accounting. It protects you from people showing better results than you by inappropriate things. I had a conversation with Charles Prince when he was the CEO of Citicorp, and they were using something called the Structured Investment Vehicle, which was a way to take debts of the bank and put them somewhere and pretend they weren't debts of the bank, and you didn't have to report them. And they got in trouble with that, and I said, I'm just curious, why would you do that? He said, because if I don't do that, I will be at a competitive disadvantage to Goldman Sachs. So that's part of it, is to have, when things are new, to have those kind of rules. The other issue I would make about regulation, to give you an example, where in America recently, I think regulation has helped innovation, and that's the question of crowdfunding and funding for small entities. Congress actually passed a bill President Obama supported called the Jobs Act, for some silly acronym. I hate those acronyms. But there has been, over the last few years in America, mechanisms for letting people with ideas get funded and get into a corporate form that was actively encouraged by regulators.
That's very true, actually. In fact, just to go on the point of where regulation helps innovation, right? If you look at electronic trading, where regulation has driven electronic clearing and settlement. I mean, it's now 25 years old. Today we are talking about online and Amazon and shopping. Nobody remembers going to a broker and buying stocks anymore. When was the last time anyone did that? 2 generations back? And regulation drove the whole cycle of making everything electronic, moving assets into electronic form, drive down the price significantly, like 20 times lower than before. So that is tremendous innovation, and it's a whole generation back. And even today, there are areas of standardization where again regulation drives it, It is also innovation, just that it is probably not cool, it's probably a little bit of boring innovation, but it's innovation all the same.
Would you then say that the Europeans are far more structured in their idea of innovation because they know what they want at the end?
Focused, yeah, I would say focused, but then the maximum impact that that I would see in cases like these is in emerging markets, in high growth markets, in India, in China, in places like that where there is also a lot of people. So the impact of innovation that pretty much originates in the US, in labs and in Europe, in Scandinavia, the impact of that in emerging markets is significant and it's very rapid. The ability to execute in these markets is very, very high. You can leapfrog a generation, even two, and then bring the innovation to market very quickly.
Yeah, so I've been dying to ask Barney a question, perhaps an unfair one. With the benefit of hindsight, what's one thing about Dodd-Frank that you would change or do differently?
Well, first of all, there's something I always wanted to do but couldn't because of the politics of it. There is the stupidest public policy in America ongoing is the fact that we have the regulation of derivatives split between the Securities and Exchange Commission and the Commodities Futures Trading Commission, and each one of them has 10 members, so you've had to get 6 out of 10 to do certain rules, and that's one of the reasons the rules were held down. The problem is that the Securities and Exchange Commission was created to regulate the financial industry, and then the Commodities Futures Trading Commission came along later for the farmers, because originally we had a debate about what would be the jurisdiction of the SEC versus the CFTC, and I proposed a very simple solution. The CFTC would be in charge of everything that was edible, which was its original purpose. But at this point, the agriculture people believe in the CFTC and the financial people, so I certainly would have gotten rid of that. Secondly, I want to do this, but I lost out because we needed a 60th vote in the Senate. We allowed the regulators to relax securitization in home mortgages more than they should have. I do not understand why, I mean, if it's a good loan, I don't understand why you object to some kind of risk retention. And people would say, well, you can't have mortgages unless you can have 100% securitization, which apparently means that there were no mortgages issued in America before about 1975. Because we didn't have any of that. I do admit one mistake now that we are going to fix, I hope, after the Republicans' overall bill dies, the $50 billion level at which you become a serious bank under the FSOC, we can raise. But yes, it would be great. I mean, Tim Geithner said to me, well, can we merge the SEC and the CFTC? And I said, yes, but not in America. I mean, just the politics were too great.
Yeah.
I was sorry that we relaxed the securitization rule.
If you have a futures and options contract on anything, irrespective of the underlying, you would think that it is the financial industry because it has repercussions for the financial industry.
Absolutely, and it's become financialized.
Yeah.
Tang Ning and Ron, do you believe that your businesses are businesses that are solving big problems in the world?
Very big. Yeah, China is a big country and the financial services is a big industry. And there are like, 60 million, 70 million small businesses in China, underserved, yeah. And several hundred million people are underserved, so huge opportunity. And I'm quite curious, Ron is an angel investor, investing in the future of financial services. I'm curious what he's seeing these days in the market, in the US and around the world.
Actually, another way to ask that question is this, that banks started by innovating, by taking the business out of the branch and making it available online and then mobile today and so on. So where's this trajectory going?
I think one of the key things here is not just having the technology or the data or the artificial intelligence and the machine learning. The incumbents have more technology people than some of the financial technology innovators. What brings us our unique ability is our agility. It's our ability to move with more speed and more purpose and get to the end point. I'll give 2 examples. One is in financial inclusion. There are hundreds of millions of people on the planet and 20 million people in America who have a mobile device. They're not on 30 days a month. They don't have an identity, let alone a financial identity. And so companies like Juvo and others, which you'll be reading about, are working with the telecoms and others to get people up and online with an identity and the ability to beyond 30 days a month, which we take for granted in the developing world, to then borrow minutes, borrow time, and borrow money.
But every time the banks understand that, they bring it back into banking.
They try. The second one I'll give you is in the Wall Street Journal tomorrow, is Avid Exchange, AVIDX Change. Huge deal being announced where banks and the traditional financial companies like Visa and MasterCard are getting off the older rails and off the old payment systems to come work with the innovators. This is one of my other investment companies. And I think you'll see companies like Juvo and Avid Exchange being adopted by the big telecoms and the incumbent financial companies also. It's happening right now, which makes it so exciting.
That's a really great point. The largest mobile internet provider in India is not Facebook. It's not some big telecom. It's an MIT startup called Jana, J-A-N-A, that Nathan Eagle started out of the Media Lab Entrepreneurship Program. And they figured out this interesting thing that, if you get people to take certain marketing actions, you can give them minutes.
Right.
And now they've got access. And it's not some poor man's internet, as some have proposed. It's actually the real internet that you can get through your phone. And so it's market-facing. It's a for-profit company, but it's putting tens of millions of people at a go onto the internet.
Yeah, I was in the US 3-4 weeks ago, and I went to a demo day. Yeah, we saw a lot of still payment and marketplace lending companies. Also, we saw insurance tech company a lot, yeah, in the U.S. These days, and also infrastructure companies, yeah, helping financial services institutions become more efficient. And what I discovered that I thought was quite interesting is that in Silicon Valley, entrepreneurs are quite young. Yeah, in their 20 or 30 years old, right? But in New York, people are dressed like us, entrepreneurs, and in their 50th and 60th even. Okay, these entrepreneurs do to-be business model, serving financial institutions. Yeah, so I thought that's quite, contrast.
And in that regard, what is the entrepreneur profile in China today? Is there something different between the Shenzhen people and the Beijing
Yeah,
people?
this is a great question. What we discovered is that, when there was a hype, a lot of internet guys, young fellows without too much finance experience came in. And many VCs had a wrong idea about financial innovation. Yeah, so they looked at wrong benchmarks, like how fast loan volume grew. It was very easy to grow loan volume, right? You just throw money to people,
Yep.
right? So is the money going to come back? That's the big question mark, right? But later on, these recent years, you find that, more finance-savvy entrepreneurs have come to doing startups, which is very encouraging.
What is the profile of an average American bank in terms of its IT capacity? Would I be right to think that in China, the average bank has got excess capacity, and in the US, the average bank needs to outsource that capacity?
See, outsourcing is a strategic decision, right? I mean, the capacity has been there, right? In a sense, it is capacity in a different way, right? So I would not think that it has got to do with the bank's capacity. A lot of times today, it is a question of whether you have the skill capacity in that country, in that region, where you want to hire, do you have the right skills, or you've got to take the skills from wherever they are available immediately and at the right price.
The purpose of my question is this, that in the US, American banks may be more likely to buy innovation, whereas in China, the average bank is more likely to absorb the innovation.
Do it on their own. Yeah.
China is one of our biggest markets also, interestingly, but then you need to be Chinese in China, right? In the sense that you need to provide very local solutions because it's such a large nation. You cannot take an American or a European solution and say that this will work. You can take a global standard, but you have to make it very, very specific to China. And in our own experience, it's been worth it because, once you do that, you have a huge market that's available for you.
The ability of large institutions to absorb innovation or the temptation to create it.
I found a couple of things. I've worked with about 8 different Fortune 1000 companies in my career, helping them build new businesses. Most big companies actually have tens of thousands of good ideas trapped inside their walls. It's at the doer level, at the individual level. And there's no way for those people to get those ideas up to the top where decisions and budgets can be authorized and made. And so that's the big challenge that I find.
The harvesting of the ideas.
Harvesting and enabling, lowering the cost of failure, increasing the reward of success. That's very, very difficult for big companies. So for a lot of them, it's easier to just buy a business. Very few large American companies are good at this open innovation process of absorbing ideas.
Yeah, in the US, we see many big financial institutions have their own venture arms doing very interesting things. For example, like we have a $1 billion fintech fund investing globally in fintech companies. Yeah, and we've done projects with Goldman Sachs, HSBC, American Express, Experian, and City Ventures. So many such players, and I've visited their teams, visited their labs. I think they are quite mindful of where financial services is heading toward, and try and build the ecosystem for innovation.
Here's the bad news. So Josh Lerner at Harvard Business School has done some excellent research on this. The average half-life of a corporate venturing executive is 1 year. Corporate venturing tends to be a lagging indicator of a market top and tends to be bulimic. So the corporate venturing will jump in after sort of the best value has been harvested, and then the market will go down, and just the time when you should be investing and buying things, they get out. They fire everybody, they stop doing anything, and then VCs come in and take advantage of that discontinuity and grow value again, and then the corporates come in again. And so I'm hopeful that maybe this time, because the tech disruption in financial services is so profound, that this time maybe it'll be different. But having looked at 100 years of market cycles in the stock markets, mean reversion would suggest that is not the case.
I'll send you our data next year when I see them again.
Yeah.
What is your
See if the same individual is
Yes,
still in the job.
that's the data I'm going to
what
send
is
you.
your gut tell you about choosing winners and losers?
You mean financial innovators, companies? So we have very detailed guideline in terms of market sizing, growth, like a business model, a team, so on. We are not like technology focused. We pay close attention to technology, but we are consumer need focused, business opportunity focused. So we have these guidelines.
Barney, you made this comment that legislation should trace innovation but not far behind. What is the tempo? Like, what is the conversation that needs to happen so that it's always there? And where did we go wrong with Lehman and structured bonds?
We went wrong with ideological. It was not something inherent in government. We talked earlier about the Washington Consensus, which I think misread.
So the narrative was wrong because
Yeah,
the narrative was interpreting everything as good until
the market, it was an overconfidence in the market and a denigration of regulation. The market was always better. Alan Greenspan exemplified that when he said with regard to subprime lending, he acknowledged in 2007 or 8, yes, I was wrong. I thought the market was self-correcting. So
there was this blind adherence to market principles, which is...
Well, what they were saying was, the market's not perfect, but it was an exaggeration of the virtues of the market and of the defects of the public sector, so that the market would always know better than the public sector. And that turned out not to be true. And what's the tempo? It is this. You don't, from the private public sector, try to tell the market where to go. You see where it is going, but you watch it closely, and that's why I'll refer to the Office of Financial Research. You figure this, the market will tell you what it's good at, but it won't tell you what the problems are. So from the standpoint of the regulators and government, you focus on the potential negatives, and when you identify them, then you got to say, okay, what can we do that will retard the negatives, like the old song, you got to accentuate the positive, and don't mess with Mr. In-Between. So that's the way it should work. Now, the historical model. In 1850, there were no large enterprises in America. By 1890, there were, but there were no rules for it. So between 1890 and 1912, 15...
Conglomerates.
Well, yeah, but then public policy came, antitrust, the Federal Reserve System, the Interstate Commerce Commission. So they had a good set of rules to deal with big institutions. But one solution can create the next problem. Once you had the large institutions, now all of a sudden you have finance capitalism, a stock market, because they're beyond the financial capacity of individuals. So what then happens is over the next 20 years, the stock market blossoms, but there are no rules. So the New Deal is putting rules in the stock market. And that model, by 1940, that regulatory model worked very well for about 40 years. And then came the money that could do securitization, et cetera. And basically, there should have been, by the 90s, there should have been some rules in place. But the dominant view, including among many in the Clinton administration, was the market knows better. It was doing very well. Part of the problem is it's very hard to make change when everybody's happy. The 90s were good years economically, and so the regulation that should have come in the 90s was delayed about 10 years and only came after the crunch.
Ron, some of the innovations that you are driving, you're very confident that we're not going to make the same mistakes because the information available in the assets that you're creating are transparent, they are clean. Is that a function of technology? It's better today in dealing with that than 10 years ago.
So I think there's a lot less leverage in the system, and I think some of the innovators have become very, very efficient in removing some of the conflicts that were around earlier in the industry. And I think there's a lot more skin in the game by some of the groups. And so I think because we've been able to work with the regulators, work with innovation and technology, and take these big total addressable markets, kind of what you said, and create these simple, efficient, online solutions, we've been able to take a lot of risk out of the system.
Can I say, and one of the things that occurred to me, I think that's absolutely right, and we don't, in the legislation that was passed, known as Dodd-Frank, we ban one thing. We say you can't lend money to people to buy a mortgage if there's really no chance they can ever pay you back. Beyond that, whether it's derivatives, credit default swaps, anything else, there are no prohibitions. There are, you say you have to stand behind it. We diminish some of the leverage. But here's one thing that occurs to me that makes me feel more confident about now, and that I think distinguishes it from the great crash of the dot-coms. And I hadn't thought about this. This has been a very useful day for me. Technology in the financial world has this advantage. The people doing it start with an agreed upon set of purposes. We want to lend people money. We want to extend credit. We want to aggregate money for businesses. And then they think about how to use the technology to accomplish these purposes. But the technology is the means to achieve the end. We have this wonderful technology. Let's think of things we can do with it. People in the 90s and the dot-com, they were inventing purposes that nobody wanted. In the end, that's why it failed. So that people were selling a product that no one wanted to buy, whereas today people are making it more efficient to get that product that has a real demand.
I think you just nailed it. So think about online lending. We have the primary market where people and institutions come to the CreditEase and Prosper type companies. There's the secondary market where now people can trade and get liquidity and trade amongst themselves. We've now introduced very controlled, lightly levered, very transparent securitization. We will not allow the financial engineers of Wall Street to come ruin this thing that we have built that's helping the borrowers and helping the
You have
investors.
securitization in the service of delivering the product. For them, securitization was an end in itself.
Correct. And so were the derivatives. And that is something
By the
that
way,
we're not allowing.
I told this to Emmanuel. You just hit on the one flaw in Emmanuel's analogy between the ICE business and banking. It's in their opposite attitudes towards liquidity.
One, you need more liquidity, the other, well, it could be insurance and banking, right? If I were to put my finger on two things that will define real innovation in financial services, one will be the balance sheet. That has to change. You know, you're not carrying assets on your balance sheet. That the balance sheet is about providing services, I would imagine. And the other is really that the intermediation business has to go. It cannot be central to the business model of a financial institution going forward. But I don't see that happening.
This is just too much of vested interest in that. There's too much business at stake in the intermediation business. So there will be continuous disintermediation, but then there will be resistance.
Let me challenge that a little bit. And so I'll say balance sheet, income statement, and intermediation. So on the income statement side, you can optimize costs through renting services. So you don't need to build a whole core bank. You can rent all of the things necessary to run a bank these days,
And then
including the balance sheet.
Technically, you pass that savings on to customers, and they don't.
And, well, a number of them do. Not all of them do, but a number of them do. That's how they can offer very low cost or free banking. But on the disintermediation side, the reintermediation, you know, let's look at money transfer as an example. Let's look at money transfer in one of the most expensive places, Africa. So money transfer rates in Kenya, for example, the incumbents would charge 13 to 15% to transfer money in and out of the country. And you'd have 5 to 7 layers of intermediation between the originator of the transfer and the recipient. With some of the newer technologies,
M-Pesa.
zero. BitPesa, even better.
Yeah.
BitPesa is cheaper than M-Pesa and successfully won a court battle against them. A friend of mine is an investor. And so there's an opportunity there. Will you see sort of cost accrete over time? Probably. It's almost inevitable. And then the next wave of innovators will come in and they'll re-disrupt.
Yeah, it seems to me that in many sectors in financial services, this intermediary position will remain. Yeah, for example, like now the marketplace lending platform becomes new intermediary. Although it's not like the taking deposit, lending out, being responsible for real-time liquidity kind of intermediary model. But the marketplace lending position is still a responsible position.
And especially for the unsophisticated.
Exactly.
Intermediation is needed for the unsophisticated lender and borrower. Somebody's going to want to, and even by the way, look, I'm thinking I'm sophisticated about some of this stuff, but particularly when I had a full-time job, I didn't have the time to think about it. I could use my foot to identify a good intermediary. And for me, being a wise investor was to pick the best intermediary.
So we're entering this full-on access economy where we're eliminating the friction. We're eliminating these intermediaries. So instead of just sharing things, we're now accessing, whether it's transportation or music or movies
Healthcare.
or lodging or healthcare or money.
Yeah.
This is really part of innovation, is letting people access each other like never before.
Yeah, I think this really beautiful world of finance is based on great investor education job. Yeah, and the investor education job can be done much better by us utilizing technology, making it very fun, making it very interactive.
I appreciate it, but here's where the limit on that is the educability of the investor. And investors will differ in educability in terms of capacity.
Yes.
And in terms of how much of their energy they want to put into that.
Yes.
And that is going to be the rule for regulation and for intermediation, is to protect the stupid and the unsophisticated and the people too busy.
And when we look at what the banks are doing in areas like Bitcoin and ledgers, for example, the idea seems to be no matter what your question, they try to look for the ways in which banks can re-intermediate the process. But the whole idea in an open ledger is that there is no center, there is no intermediator, and it shouldn't be thought of in that way. They should be agnostic and they should trust the power of the network as opposed to the power of the...
But someone's got to create the ecosystem.
Really?
Yeah, so someone has to create
Wouldn't
the ecosystem.
ecosystems get
Probably
created?
that's why blockchain hasn't picked up substantially.
Yeah, well, so a couple of things. Blockchain is in its infancy, or as I prefer to say,
Yes.
distributed ledger technologies are in their infancy. We are very early in what Gartner calls the hype cycle. So they're still figuring out what it's good for, really. But on the currency side, there's actually a real risk with the idea of a purely distributed digital currency. So central banks have been starting to play around with the idea of a digital currency, and they're running into an issue, which is if you have a truly distributed digital currency, you lose all the controls that central banks use to balance and regulate an economy. And so a lot of very ideological libertarians were raving about how great, digital currencies are, and we're going to put everything and get rid of central banks and get rid of what they call fiat currency. And then one of the larger digital currencies, Ethereum, was hacked. It was actually an instantiation of Ethereum called the DAO. So the DAO was hacked and raised among the most money ever raised in a crowdfunding event, $150 million in a handful of days, and then very quickly followed by one of the largest thefts ever in financial services. About 50 million of that was basically hacked, although it could have been prevented. And what's interesting though was not that. That's just sort of like operator error. They could have fixed the bug and they didn't. The issue was the reaction of the Ethereum community. And what's really, really interesting to me as an observer, as someone who doesn't own any Ethereum, was that all of these folks who previously, just a week prior, had been saying, get rid of interventionists, get rid of central banks, were very quickly demanding that someone intervene. And so the guy who created Ethereum, basically, it was open source, but Vitalik, the leader of the Ethereum project, intervened and acted like a central banker on this supposedly fully distributed, community.
So early days, it's not that the proof of concept probably needs another 2 or 3 iterations to reach what is intended anyway.
Its potential, yes.
But yet more than that, not all centralization is bad. That there's a reason that you have the stabilizing force of public sector.
accountability comes with that.
And accountability.
Accountability comes with
Agreed.
that.
What is achievable in the foreseeable future? Last comments from each of you. And what would you like to see as being achievable that will give you a sense of a plateau that sets the disciplines for the next phase? I think the disciplines that we have for the current phase hasn't moved very much from banking as we understand it. Transparency, trust, the intermediation business, all that stuff. But as we move more into the network aspect where we need to trust the ecosystem more than we trust ourselves, what are some of the elements that will give you a comfort level?
So for me, there's one element. For me, this is nirvana, and we call this EA&U, and it's education, awareness, and understanding. The borrowers get it, the investors get it, the regulators get it, the incumbents get it. So when we go to anywhere in the world and we ask people, what is peer-to-peer marketplace lending, online lending, that they understand, and that we have this global community where people, no matter where they are, can borrow, and people, no matter where they are, can invest. So that there's winners. There's more yield to the investors, there's better rates and better terms to the borrowers, and there is this marketplace that's serving everybody.
Yeah, I think we've done collectively a pretty good job on the consumer lending front. Small business lending is the next innovation frontier, in my view, in lending. And also, after lending, there's capital markets. There's wealth management. So I'm hoping that crowdfunding, robo-advisor can have a good future in coming 3 to 5 years, and I'm hopeful. Yeah, after that we have insurance industry coming. Yeah, so highly inefficient in many regards. So business model innovation and technology innovation can help a great deal.
We could break the credit trap that you have to have credit to get credit by applying new advanced data analytics techniques. So we could bank the 245 million small businesses around the world that today are underbanked if we adopted these new models. And those small businesses create 4 out of 5 new jobs. So we can create greater employment and thus greater economic prosperity.
I would say 2 things. One is that in about 18 to 24 months, I think there would be genuine blockchain applications which will coexist with other core systems which are there today, not to replace, but to coexist in a very pragmatic manner. So that is one. The other trend I would think would be merging of industries. You would have aspects like wearables, which are recommended by doctors but are useful for the insurance industry, recommended by financial services companies, and then useful for medical practitioners. It will just merge the industrial walls.
I'm encouraged by what I've heard about the potential for increasing equity by using the various forms that diminish the human biases that get entered. And also, it's interesting how the internet plays in this. The average, part of the problem we have with the unbanked in America is they don't trust banks. They over-trust the internet. They'll believe any nonsense anybody puts on it. To the extent that you get into this kind of peer-to-peer and other ways, and that it's accessed through the internet, you avoid, you overcome people's dislike of banks by giving them something other than a bank to deal with. Or they go to a payday lender, you should be able to get them to go to their mobile phone. But also that that you have these analytics that judge people more objectively, and maybe it's an act of faith, that a more objective judgment will lead to better treatment for people who now can't get credit. And maybe even more important, they get it, but they pay way too much for it. They get it from a payday lender, or they get it from a loan shark. So people get the credit, but you reduce the cost to them.
Okay, I'm going to put in 2 more questions. Just one question for both of you because I just remembered it, and then I'll make a comment that will be cut and paste back. The fact that we've got both of you huge players in the marketplace lending industries in your respective countries, what would you say? And we also have huge developments in payments, for example. What would you say the fundamental difference in terms of the innovations taking place in China versus the innovations taking place in the US, the choices that are being made in each of these huge ecosystems?
So I think in the US, we're actually behind China and Greater Asia in the mobile usage and experience. And so for us, we see big increases in mobile usage where you're already there. And so for us to get the business truly mobile, I think is important. I think it's also important for us to really increase the efficiency of what we're doing so that the online lenders can become cash flow positive and generate earnings and become these bigger public global profitable businesses. And I think we've seen some examples, including CreditEase and Urendai, which have done a better job, and that's been reflected in the stock market and the success they've had.
What about the choices that the US social media players are making in terms of being agnostic about building their own infrastructure on payments, on supply chain and stuff like that?
So you're starting to see it in the US. Facebook, Netflix, Amazon, and others, PayPal, getting involved in moving money, lending money to businesses and consumers, perhaps students in real estate. So I think you're going to see the financial and the technology groups, in particular the incumbent technology groups, get involved in the online lending, payments and money movement as well.
Yeah, I think Chinese companies can learn a lot from their US peers and also the US market because the US is a more advanced market in credit infrastructure and in wealth management. People's understanding of asset allocation is far more sophisticated in the US. So there's a whole lot we can learn. On the other hand, Chinese companies operate in a more competitive marketplace, and their business model innovation and in many cases technology innovation is faster pacing. So there probably the US companies can learn a thing or two from their Chinese peers.
Gentlemen, this has been an amazing conversation. The points taken in terms of what we need to look at going forward from practitioners, from people with a good feel of the ground. Thank you very much.